Hi, I'm Steve Van Metre, and welcome to your weekly economic update, where we take about 30 minutes on every Friday to take a deeper dive into the economy, charts, and whatever's on my mind. And so this week, if you haven't read the update yet, we talk a lot about the trade war. And even though this was pretty much done a week ago when China walked out of the meeting, the news broke today that the trade war may be on hold, or not on hold, but may be prolonged. You think? Yes, the trade war is going on a while because, and I really had to tip my hat to China at this point, because the moment President Trump got elected, if I was a Democrat, or if I was, a foreign power, or I was negotiating with the government in any form of trade or anything, I would have bought at least a copy of his book for everybody. And if I lived in, say, China, I would have bought a copy of the book, paid to get it translated, if it's not already, I imagine it probably is, and I would give it to everybody that handles a negotiation. Because look, if you want to know what's going to happen, why don't you read the guy's book on what he does? It makes a lot of sense to me. And sure enough, China pulled a move that President Trump uses, and he uses it when he is in a position of power, which is to walk away. And when you're doing real estate deals and you have something that other people want, it's a lot easier to walk away. When it's international trade and you're the one that's putting the tariffs on, yeah, and your partner on the other side of the table says, yeah, we're good. See you later. We're going to just go back home and not have any meetings for a while and see how things go for you. It's a pretty bold move, because I think people in the political power in China is starting to figure out one really important thing. One, the U.S. stock market does not go up forever. And number two, the moment it goes down, all of a sudden everybody should start capitulating. So they're going to play the long game, back off, see what happens. And as a result, the trade war will continue. No doubt in between now and the months that follow, there will be some more escalation. The Trump administration has filed to increase the tariffs on China, but due to the process, now we did do the initial one, but there's about $300 billion more worth of goods. That is a process that will not get into the courts until, I want to say, mid-June. So even though he said, I may wait a little while on it, well, the reality is the system has a weight to it. So it's not like he can, president can say, hey, I want tariffs, I want them today. Well, it doesn't work that way. Now in China, it works that way because they're a communist nation, but not in the United States. So in the moment, there is going to be some time to wait on that. But on June 1st, the remainder of the increase in tariffs go into effect. China adds some tariffs June 1st. So all that's going to go into effect here in the next coming weeks, which is not good news for the economy. Now, you have heard that perhaps that we're not going to have a big trade war with the European Union over automobiles. And part of the reason is foreign auto manufacturers, even domestic ones, even though they make a lot of mistakes, there's one thing they get. And they get that, hey, if you want to manufacture an automobile, try to do it in the nation you're selling most of it. It's just a better deal for you long term. And yeah, it makes citizens happy when they know that some of their cars are built, in their native country. And so the European automakers, have factories here, and I know they're committed to building more, and that would certainly get the Trump administration to back off, which it so far seems that they have. But one of the things I wrote about this week was something called a BAT tax, a border adjustment tax. And it's a little different than tariffs, and it's something I'm surprised we're not doing, but I thought it'd be worth some explanation. Now, the way a tariff works is we essentially say, look, if a good is coming into the country, I don't know which way is in, but into the country, you can bring it in all you want, but there's going to be a surcharge, a percentage surcharge, and the importing company is going to pay it. So effectively, let's say I was a jeans company, right? And I made one pair of jeans, but it was really good. People liked it a lot. And I had it made, say, in China or somewhere else. Well, when I bring that in, when that import, those jeans come into the country, I, the importer, pays a tariff. 10%, 20%, 25%, whatever it is that I pay it. Now, who am I going to pass that cost on? Well, I'll try to absorb some of it. That's normal if it's not too big, but at some point it gets passed on to the American consumer, who ultimately bears the cost of the good and the tariff. Now, from a tax perspective, when I file my taxes as a business, I'm allowed to write off cost of goods sold, which means I can write off the cost of those jeans no matter where in the world I had them made. So that's all good. Now, one of the challenges we're having, and I'm going to get into how the border adjustment tax would play into this, is the reason tariffs work. There's a reason tariffs work and don't work. They don't work when your country is A, the world's reserve currency, and B, when you're one of the largest countries around. It just doesn't work, especially when you're one of, if not the wealthiest country, or top 3 for that matter. If you're a wealthy country and you're the world's reserve currency, you have a problem, because as the world's reserve currency, your job is to make sure there's enough dollars in the world to facilitate trade, which means you need to be creating dollars. And how do you create dollars? You create dollars through trade, and tariffs generally stifle trading a bit. Now, when do tariffs work? Now, the United States has a long history of tariffs. In fact, the early colonists, the fledgling government at the time, used tariffs to keep foreign goods out, British, French goods, and so forth, and to protect the domestic economy. And it was fine because nobody wanted US dollars or colonial currency or whatever we had then. Nobody really wanted it. It wasn't a demand global currency. Trade wasn't done in it. Nobody cared about it. And the fact of the matter is, cheap British goods or cheap French goods or wherever they were coming from would have put Americans out of work. And the colonists knew that, and they needed to protect those industries, so they did. And the other benefit was the federal government was able to function just off of tariff revenues. They didn't need an income tax because they had enough money coming in. Of course, it also helped the government was a much smaller government than we have now. So what happened over time, there's a lot of history books, a lot of books on trade written about it, but it's real simple. When you have two nations, there we go, and one of them's wealthy, one of them's not, United States, China, and you open free trade between them, what happens is the standard of living of the wealthy country has to fall down to that of the poor country. And this is something that's happened since the dawn of trade. And initially, when a wealthy nation opens its borders, it flourishes. And it can flourish for quite a long time. It's not like it's a month and it's over. It can go on for many years. But there's a point where economic growth will start to flatten, it'll dip a little, and then boom. Because what happens is the wealthy nation wakes up one day and realizes it gave away all of its manufacturing, all of its wealth-creating jobs to the poor country. It's what happens every time. This is, again, not new at all. You have a very wealthy country, it becomes very poor. And essentially, you want to look at why America has gotten poor over the years. Is because of free trade. And there are very simple ways to protect it, and I don't think the tariffs are going to be very effective, but something like a border adjustment tax is. And what a border adjustment tax does is it says, look, we don't care where you have things manufactured. You can manufacture in China, Indonesia, Vietnam, America, it doesn't matter, but you can only write off the cost of goods sold that were manufactured in the United States. So if you want to buy jeans from China, you can buy them all you want. And yeah, they may only cost you $40 a pair instead of $60 in the US, but you cannot write off the $40 cost of goods. So when you sell them for $100, your corporation is going to be taxed on $100 of income, even though you had $40 of expense to get there. If you would have those jeans made in America, yes, they will cost you more, but you get to write off the entire cost of all the goods that are made in America. So in this case, if I was making them in America, I could write off $60 against my $100 profit. Where do you think people are going to have things manufactured? Well, they would have it manufactured as much as they could in the country they intended to sell it. And all that does is it takes two unequal countries and levels the playing field without leveling anything else. Because, let's just say China and the United States. We have Social Security, we have Medicare, we have all kinds of taxes, regulations, and they don't have that there. So we're not equal, but we're trying to trade on an equal level, and it doesn't work that way. So all you have to do is just equalize the system. It's no different than the Panama Canal between the Pacific Ocean and the Atlantic. Is you have the oceans are on different levels. Well, you can't just carve, a path through and be like, yeah, well, the system will figure it out. Well, what will happen is the higher level ocean will fall to the level of the lower ocean. Well, of course, the lower ocean will come up a little bit, but one side always falls. You don't see the other side go up. The idea is, well, if we have free trade, then China will be forced to do all these things and the standard of living will go up. Not true. Standard of living always falls. But in a border adjustment tax, it says, look, you can do things your way. We're going to do things our way. But if you want to sell here, you need to pay into our systems as if you live here. And by doing that, you're going to put your factory here. So instead of having one mega factory that services the entire world, so you're, say you're manufacturing in China but shipping throughout the world, it forces companies to have small manufacturing in different parts of the world, so that way everybody becomes equal. The other way you could do it is to have a global unified currency, and that's not going to happen anytime soon. So there are ways to fix our problem, but I have a hunch that this tax on American consumers isn't going to work. And it's not going to, part of the reason it's not going to work is we're in a monetary deceleration because the Fed is tightening, which means asset prices normally fall. Well, now asset prices are falling as there's less money in the system. At the same time, tariffs are pushing prices higher. So when prices rise, when incomes fall, well, then you pretty much end up in a recession because you have too much inventory building on one side and you have not enough spending on the other, and you can't get away from it. The content of this video is provided as educational and informational only, is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation of buyer selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity and opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So while we're on the charts, let's just carry forward. The money supply was relatively unchanged. This should say that it was down to 3.98. I think it just crossed over 4. So magically, we somehow oh, there it goes. Okay, cool. So now that's fixed. The 3-month rate of change is ticked back up. The 6-month rate of change is relatively flat. But this is telling us, so let's round this up to 0.7, multiply by 4. That says the annualized rate should be closer to 2.8 than 3.98. So it's telling us it's very weak growth. The money supply only increased $3 billion last week. And again, this is it's not really rising, it's not really falling, but the general trend is going to resume its downward move. And part of the reason is commercial industrial lending. Its growth rate fell slightly to 7.4%, while the back end number is rising, but the 3-month rate of change was down to 0.4. And so all of a sudden, this 3-month rate of change is just sitting right down here above 0. And when it crosses 0, you get recessions. And that was a big drop. Last week, it was closer to 1, and so it took a big drop. And that is, again, a looming red flag. Consumer loans, looking at credit cards, again, charge rates are slowing 4.39% over last year. Again, still not creating enough credit between this and this to drive this. So you get it? People borrow, increases the money supply. People are borrowing less. They're getting tapped out. They can't afford things, so they're not spending. Federal Reserve dropped the balance sheet, $28 billion. That should be most of what they're going to do this month. There'll be a little bit more toward the end of the month, but nevertheless, they dropped it. It's under $4 trillion and quickly headed to under 3.8. And these lags of all of this unwinding still have not yet hit the economy. Bank deposit growth rate ticked up just under 2%. Still very, very weak. Should be much higher at this late stage in the economy, in the business cycle, and that's not good. Looking at semiconductor sales on 3-month moving average against a year-over-year rate of change, you can see they are falling, and they lead the 12-month earnings per share of the global stock MSCI World Index, or the Global Stock Index, so taking stock of all the countries in and throughout the world. And all that's saying is earnings per share. Well, you can see how tightly that's correlated, and that is falling. So a big thank you to Macro Bond and Nordea. And here we've got, courtesy of Bloomberg and Morgan Stanley, we have the yield curve leads volatility by 3 years, and trend is up for the next 3 years. So volatility should be rising. It's not. Investors have been shorting volatility. Volatility should be rising, and when volatility goes up, usually stock prices go down. So you can see a falling yield curve shown inverted leads volatility. And again, people are like, why are you so defensive? Well, because this tells you should be defensive. So looking at lumber prices, they're a good leading indicator. Here we have lumber prices on an annualized basis, moved 6 months ahead of S&P 500 earnings per share. And just like the other chart, this says lumber prices are headed have moved down, and earnings per share should contract and head lower. And when earnings contract outside of 2016, well, you get a recession, and that's what lumber prices are telling us right now. And again, thank you to Bloomberg, Cornerstone Macro, and U.S. Global Investors. And last, provided by Sven Henrik. Could have made this one myself, but he posted it, so I copied it. Industrial Production Index is rolling over and heading toward contraction. And outside of 2016, when it does, you get a recession. So again, all this bullish narrative about the stock market is not showing up there at all. Let's go see what the banks have been up to. Remember, last week they added some Treasury security. They sold off some of their bond portfolio. This week, they pretty much added back most of what they sold. Let's say $6 billion worth of Treasury bonds. Not a whole lot for the week ending May 8th. We'll go look at the charts in a moment. They shed $1 billion in mortgage-backed securities and then bought $6 billion worth of non-mortgage-backed securities. Now, what's interesting is, let's go look at the charts. The week ending May 8th would be the 10th. So let's go and zoom in here and see the 10th. So look at that. Interest rates fell even though banks were not adding a lot of bonds. So that week they, 1, 2, 3, 4, 5. So here it was, the end of last week was right, or the week before, they only added a small amount of like I said, $6 billion of U.S. Treasury bonds. And that was enough because other people are starting to buy U.S. Treasuries now. Foreign central banks are starting to buy them. A little more hedge funds are buying them. And they're seeing the economic downturn. Plus, there's a very strong trend in lower yields here. And looking at today, we can see yields on Wednesday bounced off of their March lows. And then today kind of came down and bounced off of them again. And this is real significant because if we take a longer term chart here, what you can see is we're getting near this very strong level of support. And there's been a lot of people who have shorted U.S. Treasury bonds in here. Pretty much anyone who has short Treasury bonds since November of 2016 is in a loss position because they have to pay the interest cost along the way every month for the dividends. So they've been paying that and losing. And so what that means is when we break below 2.3%, so watch this range right in here, what that tells us is you can go back and see there's generally fairly quick moves between 2.3 and 1.9. And all that tells us is we're very likely headed back to where interest rates were when at the time of the election and in the very near future. All it has to do is break down here. So for those who are bullish on interest rates, want to see them rise, they're hoping that this is a double bottom and that this holds and interest rates go up from here. Now, looking at the bank data, we see that the banks aren't really buying bonds or selling bonds. So that would not be an indication that from a banking perspective, interest rates are going to rise. So otherwise, if we see interest rates continue to fall, this should pull this unwind through here down to 1.9, and that would kick off that major short squeeze of all these people that are short the Treasury market here. Now, what could happen? We could get what would look like a double bottom and a revisit of the 50-day moving average here in green. Would that surprise me? No. Could we get back up to this dotted purple line and retest that? Would that surprise me? No. Is any of this very likely given this trend? No, it's not. I mean, there have to be some catalyst, and we really don't have one at this point in time. I mean, what are we going to say? The trade war is over? Doesn't look like it. So there's nothing that looks to appear to improve lending demand in the near future. Let's take a look at the S&P 500. It tried multiple times to cross over this resistance level here at 2872. And on news today that things were going to be a little more difficult in the trade world, stocks sold off toward the end of the day, closed below their 50-day moving average and below this area of resistance. So when stocks cannot make new highs, and they're not, I mean, for the last 15 months, stocks have not gone anywhere. At some point, you realize what's called buyer exhaustion, where buyers do not have enough money, do not have the desire to take prices higher, and that's when sellers come out and bring the market lower. So looking at this recent chart pattern of trying to go up and then down at the end of the day, down at the end of the day, down at the end of the day, it's starting to look like the bulls are running out of ammo, and that should bring the broad stock market down. Now, from a position of volatility, We look at the volatility chart, and it got back over or underneath its 200-day moving average on the VIX. That was important, but it needs to get back up here to really cause volatility to shoot higher. So we should be watching volatility in the next week or two to see how the market's going to respond. But we can look at the ETF, the Volatility ETF, which you should never buy or sell or do anything with, and it held its 50-day moving average. Today it broke below it, and it closed right above its 50-day moving average. And when a stock crosses its 50-day moving average to the upside and confirms it, in this case confirm once, confirm twice, it tells you that the next direction is likely higher. Now, we did see that prices got rejected in this resistance zone. This would be overhead resistance between these two blue or purple lines, and it got resisted under its 100-day moving average. I meant to say rejected at its 100-day moving average. So that means we should get another shot up into here. And if this does not hold, then we start making moves higher in the volatility space. So volatility is starting to tell us that, yeah, this narrative in the stock market of being rejected here, well, it's looking valid. It's looking very, very valid. All right, so let's go on and look at oil and gas producers. So here are oil and gas producers. They look like they were trying to rally last couple of days and got rejected here. This is an area of support. These two purple lines are functioning as support right now, and prices are consolidating here. They're going sideways, and markets are hoping for them to go higher, but usually the consolidation periods like this are a continuation. So we expect the trend to continue, and at some point this will break below and head down to revisit its December lows. Now, how do I know that? Well, because oil prices are very much correlated with lumber prices, and we can go in here and we can put in the symbol for lumber, the ETF, and let's look at a one-year chart, and you can see that when lumber starts to head down, oil shortly follows. When lumber starts to recover, oil recovers. And look here, this is a beautiful chart pattern. And you can see lumber is headed lower. In fact, lumber is headed toward its December lows. What's it going to do? Drag oil prices down. So what can we interpret this as investors to mean? Well, it likely means that the inventory reports for crude oil in the coming weeks should show build, meaning they should show demand for oil, this price is too high, and that inventory levels are increasing. That should bring prices down. Now, I think they're going to break through their December lows and will present a pretty excellent buying opportunity in the future. Exactly when, I don't know, because I don't know when they're going to break it, but I do know they'll spend some time down there. So it's not like, oh my God, it broke it, quick, get ready to buy. There's so many shares of oil company stocks out in the market just in general. It takes a while for them to get absorbed. So the bottom will take a little while, but we're not there yet. And lumber is telling us everything we need to know. Now you say, well, I don't know about that. Okay, well, let's put in the 5-year Treasury yields, FVX. Let's do that because it also follows those. FVX, oh, whoops, FVX, okay. And there's 5-year Treasury yields. And 5-year Treasury yields are validating that. They're saying, yeah, they should be oil prices should be near their December lows because 5-year Treasury yields are back down at their March lows. And that is also telling us that 10-year Treasury yields should be headed lower. So we're seeing two different indicators that are telling us that oil and gas stock prices should be lower. Here you can see 10-year Treasury yields against 5-year leading them lower. So now we know that there's no reason to panic and jump into oil stocks. They're headed lower for sure. So let's take a look at gold. All right, so gold broke. It came back up. I mean, it couldn't sell here, couldn't sell, came back up, touched resistance, immediately rejected. Now it's heading down. I mean, these people here that were buyers are probably going to become sellers. This will drive prices down. The next level of support is this 1240, 1250. It's more likely, I think, that we're going to get down to this 1200 range. Now, why would I say that? Let's zoom out to the 2-year chart. Let's look at silver real quick because this is going to come into play. Look at how silver is making a fast track down to its 2018 lows. And if we zoom out on silver, we see that it's not far from its 2015, 2016 lows. This is interesting because if silver gets down here, well, that means the silver mining stocks are headed way down into here somewhere. Now this pattern here looks like an inverted cup and handle pattern. And let me show you what that looks like. I'm going to go inverted cup and handle. I'm going to pull this up and then we'll go look at that browser. So some of these are, there's one in here that is charted the proper direction that I see. Most of these are charting a little bit backward from what we're seeing here. So here, what a cup and handle is when you get this kind of downward move and then this rounded part. So you see, here's your handle, here's your cup. Now it's interesting because this guy says a cup and handle is not a reversal pattern. Well, it's not normally. It can be, it just isn't normally. So what that tells us is, here's your handle, here's your cup. As I pulled out my technical analysis handbooks. Yes, they do exist. And you take this $28 to the edge here, 23. So there's a $5 difference. And then you take 23 and you subtract 5. And it says the target move for this is $18 right here at its December lows. Now, for those of you that are still here, why is this interesting? Oh, because one, I got to write about this stuff in the week. I still can't figure out how there's any solution but to figure out how to print money. But there's something that happened in late 2015 that kicked off this rally in gold. And China had to devalue their currency. And I'm going to tell you, they're going to do it again. And so there's a bit of rush now to flush people out of this. Now, why would you want to do that? Well, got my trusty calculator here. Let's go over to the charts and let's say you roughly bought in here somewhere near the bottom because you knew this. Let's say you bought in at 18. So I'll put 18 in my calculator, and that will say, we'll say you bought in January and you went 8 months later, or let's say you missed the top and you sold somewhere in here around, I don't know, $45. Not even a year later. Okay, so put $45 in. We'll say no contributions, less than a year, but still 1 year. That was 150% return in about 9 months. All because China devalued their currency. They're going to have to do it again. Oh, they're going to have to do it again. And the best part is when the bull market in this space kicks off, it's even better because not only do I happen to know someone who is a geologist and helps companies, but I do a lot of reading and other people that follow the sector, and they're saying the supplies, the exploration is way down. There isn't a lot of gold in the ground that's readily available. It's expensive to get, and when the demand for this hits and there's a little supply, price, let's see now, which way? There. That's the direction you can see prices go up. And they're going to go up just like you see here. So how excited am I about this pattern breaking down to, say, 18 and wanting to buy there? Huge, because if you copy over GDX, what you can see is the gold miners need to come way down. They need to come down a long, long ways. The gold mining stocks need to be around $15 to $16 from their current price up here at 20. That's a 20% hit. That would be huge, and that would be an excellent opportunity to buy. All right, so we've got a couple minutes left. Let's hit some more charts. Here's the 7 to 10 year Treasury bonds. If you can't see this as a bullish pattern, it doesn't get more bullish than this. Double bottom, prices are rallying. There you go. So people right now are hoping that this is a double top, not when the banks are still buying on bonds and the market's rallying, even though they're not buying many of them. Yeah, when the banks start selling, then you call me and tell me that the double top is in. Looking at the long bond, that's in place there. That's all good. So here's what surprised me today is the ags sold back a little bit, even though the news was quite the opposite. Now we got some really interesting news that's telling you what I've been telling you. But let's look at the weather report. There is I'm not the weather report. Weather report. So in the next 6 to 10 days, there's this massive cold front moving through the western United States. Big storm here. and rain a coming again. Now, where's this headed? Now, people in the Midwest are starting to complain because the storm is headed east and there's rain coming and more rain to follow all through here. Now, why is that? Should that matter? Well, China did not put any tariffs on corn or wheat because they need them. The swine flu, they're killing hogs left and right. And there are now rumors that the swine flu is inflicting other nations in Asia. It's unconfirmed, but there was at least one report that yes. And once you get the swine flu rolling, there's no solution. You got to kill them. I mean, you just have to. It's the way it works. So with that, it is corn planting season in the Midwest. China's not tariffing corn, not tariffing wheat because they're going to need food from somewhere. 30% of corn crop has been planted. Historically, we should be 5-year average. We should be at 2/3 of the corn crop planted by now. And the farmers back there are saying, one, I can't plant because I'm underwater. Number two, this next rain, I'm not going to be able to plant. And those who just planted are saying this rain is going to hurt my crop because hybrid seeds require ideal planting and growing conditions, and we're not seeing it. So again, solar minimums cause prices in ags to go up because there's not only crop damage, but there's other damage, supply damage, everything gets hurt. And right now we're facing corn crops. Let's just say they get up to 40% planted. We're talking a big drop, which means prices will go higher. And some farmers are saying, I don't even know if I'll be able to plant next year after I get this mess from the last storms cleaned up. I'm Steven Van Metre. I'll see you next week. Bye now.